Discover the foundational metrics every investor should know about. As Warren Buffett wisely said, price is what you pay, value is what you get. Many investors focus solely on stock prices, but the real money is made by understanding what's actually happening inside these companies. Today, I am going to show you the 5 most important financial metrics that will transform how you look at stocks. But rather than getting stuck in theory, we are going to dive into my stock analysis library and examine real companies to see these metrics in action. By the end of this video, you'll know exactly what separates a great investment from a terrible one. Return on invested capital, or ROIC, is like a report card for management. It tells us how efficiently a company turns invested money into profits. Let's look at Apple here. Their return on invested capital is 31.1%. That means that for every dollar Apple invests back into the business, they generate over 30 cents in profit. That's incredible efficiency. Now compare that to a company like Kraft Heinz with a return on invested capital of just 2.9%. And straight away we see that this company is struggling to generate meaningful returns on their investments. We want to see return on invested capital above 10%. Anything below that, and you should ask yourself, why isn't management doing a better job with shareholders' money, with your money, if you buy shares of this company? Businesses with consistently high return on invested capital tend to have what Warren Buffett calls economic moats, competitive advantages that protect their profits. This metric should be one of the first things you check when analyzing a company. Next, let's talk about net debt. This is your safety net as an investor. Net debt is simply a company's total debt minus their cash. It tells us how much debt a company would have if they used all their cash to pay it off today. Look at Chipotle Mexican Grill. We have here years to pay debt at 0. But that only shows us the current situation when it comes to long-term debt versus free cash flow. Net debt is shown down here on the graph, and you can see they've actually had negative net debt for years. And we want it to be negative. That means they have more money in cash than they owe in debt. That's an incredibly safe position. Now let's look at a company that's struggling, like AT&T. It would take them over 5.5 years to pay the long-term debt with current free cash flow. But more importantly, as we can see on the graph, they have huge net debt of around $130 billion. That's a massive burden. Every year they have to pay billions just in interest before they can invest in growth or pay shareholders. It's like driving on the freeway with an open parachute. You can do it, but it's not the best way to go fast. When times get tough, which company do you think will survive better? The one sitting on a pile of cash or the one drowning in debt? We generally want to see companies that can pay off their debt in under 2 years with their current free cash flow. Any longer, and it becomes a risk. Earnings per share growth shows us how much money a company is making for each share over time. Let's examine Nvidia here. Their earnings per share growth has been absolutely explosive, over 51.3% annually. Each share of Nvidia has become dramatically more valuable because the company keeps growing its profits. We can see on the graph here that it was a pretty steady growth and then an explosion of earnings after the AI became a new thing. Compare that to a mature company like Coca-Cola with earnings per share growth of 4.4% annually. Still positive, but much slower. That's fine for a dividend-focused investment, but don't expect explosive returns. We are looking for companies growing their earnings per share by at least 10% annually. And in the best scenario, we would prefer this growth to be consistent over time. That is why we have a history graph here. And we want to look at per share basis instead of just the earnings, because as shareholders, we want to make sure we are not getting diluted. Now we get to the climax, free cash flow growth. This is the most important metric because it shows real money the company generates that can be used for paying back debt, paying dividends, buybacks, acquisitions, or reinvestment. And what is important to understand is that earnings can be manipulated with accounting tricks, but free cash flow is actual cash hitting the bank account. Free cash flow is like the real world, and earnings are more like Instagram. They don't always accurately describe reality. Let's look at Amazon. Despite having a relatively modest earnings for years, a decade ago they were still unprofitable. That is why earnings per share growth cannot be calculated here. But at the same time, their free cash flow has grown steadily by around 34.7% annually. This real cash generation is what allowed them to invest in new business lines and ultimately dominate multiple industries. Free cash flow represents a company's true financial health. If a company can't generate consistent free cash flows, everything else becomes meaningless. And that is why we want to see free cash flow growing at least 10% annually over the long term. Finally, let's discuss dividend yield. This is your regular paycheck from owning the stock. Dividend yield is the annual dividend payment divided by the stock price. It tells you what percentage return you're getting just from dividends. Look at a company like Dollar General with a dividend yield of 3.1%. That means if you invest $1,000, you'll receive $31 per year in dividends. But don't just chase high yields. We want sustainable yields between 2 and 5% from companies with growing profits and reasonable payout ratios. An 8% yield might look attractive, but if the company is struggling and about to cut the dividend, you will lose a lot of money and fast. That is why it is wise to also look at other factors like payout ratio or dividend growth. But if you would like to learn more about becoming a dividend investor, then go to stockinvesting.academy and choose our beginner-friendly dividend investing course. You can also find the link in the description. Let me show you how all these metrics work together by looking at one final example. Let's choose Microsoft from our analysis library. It has a 22% return on invested capital, which means that the management is doing a very good job and showing strong efficiency. Then we see the net debt is positive, so it could be better. They could have more cash than debt. But we also see that it would take them less than a year to pay the long-term debt with a current free cash flow. So it is not a real problem. They have it under control. Now let's move to growth. And as we can see, the earnings per share is at 14.1%. So that is a solid growth. Also on the graph we see it is pretty stable, so that is also very important. It gives us much more confidence that they can replicate these results in the future. Then we have free cash flow growth, and that is at 9.2%. We prefer to see it over 10%, so it is not great, but still very close to what we are looking for. And finally, let's look at the dividend yield. It is only 0.7%, but because it has a low payout ratio and is growing very nicely for the years, it is actually a nice bonus for this strong and growing company. So when we go through all these 5 steps, we can see a story emerging. Microsoft is effectively growing their profits, has a very strong balance sheet, generates massive amounts of real cash, and returns some of those money to shareholders through dividends. There is not a lot to dislike about such a company. That's what a quality investment looks like. So there you have it, the 5 essential metrics every investor should understand. Don't get overwhelmed by hundreds of metrics. Master these 5 first, and you'll make better investment decisions than 90% of people in the market. If you found this helpful, make sure to check out our Patreon page and explore tools like Analysis Library or Analysis Table Pro. Also, you may find my video about compound interest very helpful. Thank you so much for watching and see you in the next one.